In a Tesla SEC filing, you can read the line in plain English: 238 million Tesla shares pledged as collateral, about 1/3 of Elon Musk's stake in the company he runs. He didn't sell them, he borrowed against them. A separate stack, roughly $13 billion, funded the Twitter takeover in 2022. Musk did not need cash. He had paper wealth measured in hundreds of billions. He used debt anyway. The strangest part isn't that the richest man in the world borrows money. The strangest part is that he borrows for a reason printed in the U.S. tax code, and almost nobody outside finance is taught to read it. To understand why a billionaire borrows when he doesn't need to, start with the price of debt. In 2025, the average American consumer with a credit card pays roughly 24% annual interest, none of it tax deductible. The full sticker rate, the average homeowner with good credit pays about 7% on a 30-year mortgage, deductible up to $750,000 of principal. A high net worth individual at Morgan Stanley, Goldman Sachs, or Schwab borrows against their stock portfolio at about 5.5%, the secured overnight financing rate, plus 1 or 2 points, often deductible against investment income. A AAA-rated corporation like Apple issues 10-year bonds at about 5%, fully tax deductible at the corporate level. Same instrument, debt, 5 different prices, spread between the cheapest and most expensive, roughly 5 times before tax, 6 to 7 times after tax. That spread is the entire engine. The Federal Reserve estimates the U.S. securities-based loan market, debt collateralized by stock portfolios, at $138 billion outstanding. Major brokerages all offer it, typically with an account minimum of $100,000. The latter is real. Schools teach the top of it like a warning. They don't teach the bottom of it like a feature. On paper, the case for using debt as a wealth amplifier makes sense. 5 clean arguments line up behind it. The arithmetic argument. If the after-tax cost of borrowed money is lower than the after-tax appreciation of what you bought with it, the borrower gets richer every year, mechanically. The tax argument. In the United States, the proceeds of a loan are not income. Selling a $1 million appreciated stock position triggers federal long-term capital gains plus the net investment income tax, roughly 24% federal, more in high-tax states. Borrowing $1 million against the same position triggers zero income tax. The first dollar of liquidity costs nothing in tax until you sell. The risk pricing argument. Lenders price debt according to the borrower's collateral, credit history, and default risk. A consumer with no assets and an uncertain income stream is not a comparable risk to a corporation with $140 billion in liquidity. The pricing reflects that. It's not a moral judgment. The deduction argument: corporate interest is fully tax deductible. Mortgage interest is partially deductible. Investment loan interest is often deductible against investment income. The U.S. tax code subsidizes debt by design, going back to 1913. The social argument: capital flows toward the highest expected return. Lending money to investors who will turn it into more money is structurally productive. The economy needs leverage to function. The mechanism isn't bad in itself. 5 arguments, none of them wrong. This episode isn't an indictment of debt or wealth or capital markets. It's a structural observation about a specific gap, the gap between the consumer side of the system and the asset holder side of the same system running on the same instrument. Picture 3 concrete cases, 3 different tiers of the same playbook. Case A, the billionaire. Elon Musk holds Tesla stock at roughly zero cost basis. He founded the company. Selling $13 billion of those shares to fund the Twitter purchase would have triggered roughly $5 billion in federal plus California tax. He borrowed instead. Interest on the loan, roughly 5 to 7%, costing him in the high hundreds of millions per year. a fraction of the avoided tax. As long as Tesla appreciates faster than the after-tax interest, he's net positive. Case B, the public corporation. Apple Inc., as of March 2025, has roughly $46 billion in cash and equivalents. It has roughly $97 billion in outstanding fixed-rate notes. It has a net cash position of around $62 billion. Apple is not borrowing because it lacks money. Apple is borrowing because the after-tax cost of debt is lower than the implied cost of repatriating overseas cash, lower than the cost of funding buybacks with retained earnings, and the interest is fully deductible. Total shareholder returns since Apple's first big bond in 2013, roughly $732 billion in buybacks and dividends. Case C, the landlord. A real estate investor buys a $500,000 apartment with a $100,000 down payment. The bank lends the rest at roughly 7%. The tenants pay the mortgage. The property appreciates at 3 to 4% per year. 20 years later, the property is worth around $1,096,000. The mortgage balance is well under half what it started at. The investor's equity has grown roughly 9 times, from 100,000 into multiple hundreds of thousands. The same 100,000 in a savings account at 4.5% grows to about 241,000. 3 tiers. Same instrument, same direction. The borrowed money does the work. The owner keeps the appreciation. Most people picture this as a personal story. Some people are good with money. Some people are bad with money. Some people get lucky. Sometimes those are real. Underneath them, the actual frame is older and simpler than personality. In the mid-1990s, Edward McCaffery, a tax law professor at the University of Southern California, gave it 3 words. It's just buy, borrow, die. Buy, acquire appreciating assets. Stock, real estate, private equity. Don't sell them, borrow. Use those assets as collateral for loans. Live off the borrowed money. Debt isn't income, so it isn't taxed. Die. At death, U.S. Tax Code, Section 1014 resets the basis of inherited assets to fair market value. All accumulated gain over the holder's lifetime is permanently extinguished for income tax purposes. He called these rules planks of the law that had been in place for 100 years. For 25 years after McCaffery coined it, the phrase was dismissed by tax professionals as oversimplified. In June 2021, ProPublica obtained 15 years of IRS data on the wealthiest Americans and confirmed it with surgical precision. 3 steps, 1 framework, same 100-year-old law. Schools teach the consumer side of debt. They almost never teach the rest. This episode is sponsored by my own private community. If McCaffery's 3 words made you want to apply this lens to your own balance sheet, this is built for it. A community where I work through over 100,000 applied breakdowns. How S-blocks actually price, how depreciation actually shelters cash flow, how the wealth ladder actually compounds. Not theory, applied to real decisions people are about to make. Link is in the description below. All right, back to the diagnosis. Once you see the framework, the rest of the story is what it does. At the level of 1 tax return and 1 balance sheet. At the level of 1 tax return, ProPublica's 2021 analysis of the 25 wealthiest Americans, covering the years 2014 through 2018, found that those 25 people grew their combined wealth by $401 billion. They paid $13.6 billion in federal income tax over those same 5 years, a true tax rate of 3.4%. Warren Buffett's true tax rate over that period, 0.10%. Jeff Bezos, 0.98%. He paid no federal income tax at all in 2007, again in 2011. Elon Musk paid no federal income tax in 2018, $65,000 in 2017, $68,000 in 2015. By comparison, the median American household earning $70,000 a year paid roughly 14% federal effective income tax over the same window. None of those billionaires committed fraud. They followed the law. The same 100-year-old law McCaffery described. That's the asset holder side. Now the consumer side. U.S. households hold roughly $1.3 trillion in revolving credit card debt, the New York Fed's 2025 estimate. Average APR around 23 to 24%. Median balance around $2,800 per household. A household paying the minimum on a $5,000 balance takes 7 to 12 years to clear it, paying more in interest than principal. Same instrument is a debt. Two opposite balance sheets. The richest pay 3%. The bottom half pays 24%. Once you see the mechanism in full, the system stops looking like corruption. It starts looking like composition. 3 structural rules of U.S. tax law, none of them individually unreasonable, combine to produce the asymmetry. Rule 1. Debt is not income. Reasonable because a loan creates a corresponding repayment obligation. But combined with the other 2 rules, it becomes the engine for tax-free liquidity. Rule 2. Asset appreciation is not taxed until realized. Reasonable because you don't tax someone on a paper gain. But it lets unrealized appreciation compound for decades while the holder lives off borrowed money against it. Rule 3, Section 1014 of the Internal Revenue Code resets basis to fair market value at death. Reasonable in isolation on the theory that the estate tax already handles transfer of wealth. But for income tax purposes, all accumulated gain across a lifetime is permanently extinguished. Each rule alone looks like reasonable tax policy. Together, they produce a wealth machine that runs in opposite directions for the 2 halves of the income distribution. For the consumer with no appreciating assets, debt is a transfer to lenders, the bottom half of the credit card market. For the asset holder, debt is a transfer from the U.S. tax base to the asset holder, the top of the income distribution, 3.4% true tax rate. For the corporation with overseas cash and a low borrowing cost, debt is a transfer from the tax base to shareholders by way of buybacks. Apple's $732 billion since 2013. Same instrument, same 100-year-old law, composed at 3 different scales. For an individual participant, this means 3 things. There is no person to blame. There is no policy that addresses all 3 rules simultaneously. There is no exit ramp the system itself provides. That doesn't mean there's no exit. Recognizing which side of the asymmetry you stand on is the first move. Building the kind of balance sheet where the next dollar of debt amplifies wealth instead of extracting it, that's the second. The default is pay 24% forever. 3 operational rules to take from this. Rule 1. Know which side of the asymmetry you stand on and price your debt accordingly. If you are paying 24% on consumer revolving credit, you are on the extracted side. Every dollar of that debt is a transfer to the lender. Episode 1.1 covered this side in detail. Pay it down before you do anything else. If you have appreciating assets, the same dollar of debt at 5.5% S-block pricing is on the amplified side. Different math, different decision. Rule 2, don't sell what compounds, borrow against it. This doesn't require a billionaire's portfolio. The same logic applies, scaled down. If you own a position that appreciates faster than the cost of borrowing against it and you need liquidity, the math favors borrowing over selling. Selling triggers tax, borrowing doesn't. Holding through tax-deferred accounts, holding to step up, these aren't tricks. They're written into the code. Rule 3, the cost of capital is the most important number you'll ever know before any major financial decision, ask, what is the after-tax cost of the money I'm using? What is the after-tax return on what I'm using it for? If cost is below return, leverage helps. If cost is above return, leverage hurts. The asymmetry is not in the instrument. It is in the spread. These are operational rules, not philosophical ones. They don't fix the system. They give you a way to stand inside it on the side that compounds. 238 million Tesla shares pledged as collateral, printed in a public SEC filing. Edward McCaffery wrote the explanatory note 30 years ago. It's just buy, borrow, die. 8 billion people now wake up every morning inside a system whose two halves run on the same instrument in opposite directions, 3.4% at the top, 24% at the bottom. Nobody anywhere chose this in the way you choose a movie at the cinema. It composed itself out of 3 rules of tax law nobody objected to individually. If you want more breakdowns like this, and subscribe. There's a lot of math worth understanding. Numbers don't lie, but they don't explain themselves either.